What's up, everyone? I'm back again with another stock, and this stock is going to be CVS Health. Now, before I get into the stock, let me tell you what's my requirement. Well, my requirement is that it pays a dividend.
What exactly is a dividend? Well, a dividend is just a payment made by a company to its shareholders, okay?
It's on my dividend portfolio. Of course, we want it to pay dividend. Number two, it has to be in good financial health. And number three, it has to have a good growth opportunity. So those are my three requirements. But now,
Quickest way to not be on a beach in Mexico is to think that passive income exists. I think the reason so many scumbuckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero, and you put them in the two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate.
why am I building this account? Well, I'm building this account to build a bridge account and a passive income. I want to build this account to maybe $1 million so I can get a passive income from it and not worry about retirement. So this is the reason why.
Hundreds of pages. And I read that whole thing over and over again. I read Garfield Drew on us. I read everything. And I thought the first 8 years, I thought the important thing was to predict what a stock would do.
I want to build another leg of emergency for retirement. So let's get into this. So if you don't know what CVS Health is, it is the pharmacy department at CVS. And it has, let's look at all this information. It has earnings, stock, dividend. Well, they don't really have much on it besides that the investors information. So let's go into looking at what it really is. So let's look at the charts and see how has it been doing. In last month, it's in a -4 or -6%. 3 months, -7%. Year to date is up 39.16%. 1 year is 5.31%. 3 years is -338.9, and 5 years is -0.75%. Projected analysts, let's see what they really say about this. Looks like it's gonna flatline according to this. All right. Let's look at the dividend first before we look at it. It doesn't look like it has a great growth opportunity. So let's look at it. So it has a dividend yield of 4.26%. That is a pretty good dividend yield. And they have an annual dividend of $2.66. And the payout ratio is 74.09%, which is a very, very high dividend payout. If you don't know what a payout ratio is, it is pretty much how much profit they give you from. If you don't know what a dividend payout is, a dividend payout is financial metric indicator proportion of the company net income that's distributed to shareholder as a dividend in the calculator using this formula. Dividend payout ratio equals to dividend paid divided by net income. So now you know what it is. But let's look at this. It looks like they're very consistent. They've been increasing it for the last 3 years, and buyback is at 1.02. So it does pay a really good dividend, but I have issues with this payout ratio. It's really high payout ratio. It's just something you don't really want to be that high if you're looking for growth. All right. Now let's look into the finance. So the revenue growth. Let's see how it's been doing for the last few years. So last year it made $372 billion. Really good. And then the following year it had 357 billion and 322 billion the year before. So it looks like the revenue growth is pretty good. And if you didn't know, Investor measure growth by how fast the company revenue sale is growing year over year. So this is what revenue growth is year over year. Now, the cost of goods when it increased, but let's look at the gross margin and net profit and see what they're really doing. The gross margin is 13.79%. That's not a very high gross margin. That's actually pretty low. And the net profit is 1.3%. I do not like this net profit being so low, especially since 75% of the payout is based off the profit. It might be including the dividend in it, but 1.23% isn't very good to look at. Now, let's look at the balance sheet. So what I like to do on the balance sheet is get the current asset and the fixed asset, add them together, and subtract the current liability and long-term debt and see if it's more or less. So they have more assets than they do have liability and debt. So that's pretty good because 184 and 68, and then current liability is 84 billion and long-term debt is 59 billion. What I also like to look at is their long-term debt increasing or decreasing? And according to this, 2022, 2023, and 2024, they have been increasing their debt. I do not like that. I want it to either stay the same or go down. And then the fixed asset, I like to see that go up, or the current asset to go up year over year, and the current liability to go down with the long-term debt. So it looks like they're borrowing money and putting themselves more liability. It looks like they've been increasing their liabilities every year since 2017. And long-term, they've been increasing it and to 2018 to 71 billion. And then it started decreasing and they increasing again. And shareholder equity is 75.56. Now let's see what their cash look like. Cash flow tells you everything about the company, if they're doing good, doing bad. So in 2021, they're at 18.27 billion. 2022, 16.1 billion. 2023 is 13.43 billion, and 2024 is 9.11 billion. And if you don't know what operation cash flow is, it's the cash generated by the company's business operation, and it's been going down. I don't like that. That means the operation cash funding is being lower every year, and they're spending more than they're bringing in. Now, I also like to look at the free cash flow position. So 6.3 billion in 2024. It dramatically dropped from 2023 from 10.4 billion and dropped from 13.4 billion. So yes, they've been spending more money. So it looks like they're not in a financial stable position. It looks like they're using more money than they are making. But if you look at the summary, or you look at the other finance, you see that they're in the net profit. This is why you can't just trust the statements. You have to look at the cash flow, because the cash flow will indicate everything you needed to see. Let's see what investors are in there too. I like to see. I have no idea any of these investors. Let's see exit shareholders. Maybe some of these are big companies, but I don't recognize any of them. So let's see. And then now that I looked at the dividend, it pays dividend. I look at the finance. The finance isn't looking too sharp. Let's look at what AI say about future growth and what I think about the future growth of this company. All right. So MSN gives us this AI. I like to use it. So the valuation is 6 out of 6. Yes, I agree. The valuation is low for what it is. It's undervalued for the pricing. So that is good. But the earning is 2 out of 6. Now, I don't actually think the earning is 2 out of 6. But if you compare it to everyone else, yes, it's 2 out of 6 because they compare it to Walgreens. Walgreens is a big negative 39.68. McKesson Corporation is a big corporation that sells to the hospital, and Cardinal Health is another big corporation that sells to hospital. And CVS is a standalone, and they're at a negative 0.09%. So they look like they're still losing money. The future growth compared to everyone now, this is the earning per price share. Walgreens is a negative 31, and CVS is positive 32.38. But if you compare it to these other Cardinal Health and McKesson Corporation, they are doing worse than Cardinal or CVS. But I don't think the future growth is there. Still, I think AI is wrong here. And let's check historical performance. Yes, historical performance looks like it's bad compared to the peers. So yes, I see it. Peer average is 227 and McKesson and Cardinal Health. So it looks like it's in a negative net profit growth and net profit growth. So it's a negative still. And then financial health, current ratio versus peer industry. So it is less than everyone else here, but I still don't like it because the financial health doesn't look that great. So what does the analyst say about it? Well, the analyst says to buy it. And I personally do not think this is a buy unless you're looking for a long-term stock that possibly can do good. But at the end of the day, for the short term, I don't think this stock is going to do very well until it gets out of the negative. And then let me see. Let's take a look at the top stories real quick, see if anything good or bad came out. Kramer. So Kramer is this guy right here. He actually talks a lot about stocks, and I used to follow him, but he does not actually have a good rep on stock performance. If you look at his number, I think every time he picked a stock, it went the opposite way. I had to look at that again, but I don't like it whenever he reports a stock because normally those stocks don't do as good as it says. But at the end of the day, what do I think about CVS Health Corporation? Well, at the end of the day, they do pay a good dividend. So the dividend is not the issue. The finance is the issue with the good growth. So it does have growth opportunity. I do see that. But CVS hasn't implemented anything new that I saw in the news to help it grow for the health department. Now it's always going to be around because of the pharmacy. Everyone, local community gets their drugs from there. So yes, I can see it going around, but I do not see a major growth in it. And with the finances being how it is, it's getting worse. I just can't buy it. Financially, it doesn't make sense to buy because it doesn't really earn money. They're not really good in a profit margin, even though they pay a good dividend. Yes, they pay 75% out, but at the end of the day, I want a good growth stock because this is for a long-term investment and it's not really for the dividend now. And like and subscribe to my video, and that's all I got for you.